Hello, fellow traders worldwide. This is Gabriel. You're very welcome to Forex.Real.Trader coaching sessions. Again, thank you very much for your support, for being part of this community of independent and retail traders in Forex. Once again, remember that the intention and the purpose of my channel is to provide reliable, accurate, and honest information. It is important to mention that I'm not a financial advisor. Everything that I provide in here is only based on my experience on things that have worked with me in the Forex industry. Today's module, as we mentioned in the previous video, today we start the coaching course. So we're going to work with the introduction to Forex. I promise that every information will be accurate, simple, pragmatic. I'll try to avoid unnecessary jargon because I understand that there are lots of things out there that try to make things pretty complicated. Trading is simple. Remember what I mentioned in the previous video. One thing is easy, another is simple. So we're going to find out how simple it is. But remember, we need discipline and we need commitment with every single thing that we do in Forex. So today's module is about the introduction, right? It's about the introduction of the different aspects that we need to understand about Forex trading. I'm sure that you have heard lots of things, so I'm going to be very pragmatic, I insist. So very simple definitions and very pragmatic and practical ways to apply the different concepts that we're going to learn in the Forex market. All right, so the very first thing here is to talk about the reason because I created the coaching sessions. You know, the world of Forex trading is fascinating yet highly complex, and many aspiring traders struggle to find reliable and realistic guidance. After years of experience navigating the market, I realized that there is a significant gap between what most new traders expect and the reality of trading. One of my goals is to bridge that gap by providing practical, honest, and actionable coaching sessions. These sessions are designed to equip beginners with the foundational knowledge and tools they need to make informed decisions and avoid common pitfalls in the Forex trading. Okay, so that is one of the most important reasons. Now, let's define Forex. So what's Forex and how it works? Forex is the acronym for foreign exchange, right? This market is the largest and most liquid financial market in the world, where currencies are bought and sold. Unlike stock markets, the Forex market operates 24 hours a day, 5 days a week, and is decentralized, meaning there is no central exchange. Instead, trading occurs over the counter, something called OTC, through a global network of banks, institutions, and individual traders. Currencies are traded in pairs, with the first currency being the base currency, and the second is also called the quote currency. For example, in the pair euro-dollar, right, the euro is the base currency, and the dollar is the quote currency. So let me show you this on the charts. For example, we're going to identify a pair, right? So in your MetaTrader 5, you can identify this by opening, right, your profiles if you have them, or by opening just new charts. So you can see here Forex majors, exotics, and minors. So we focus on the majors. That is the first thing. Try to avoid as a rookie trader, we avoid exotics and minors because the volatility is pretty high. The spreads are pretty high too. So it's better to focus on the majors. So here we have, for example, this one, euro-dollar, euro-Japanese yen, Australian dollar, American dollar, Swiss franc. Those are majors. Now I'm going to explain in detail all of them. But the thing is what? That all the time we trade in pairs. Okay. Here we have the major currencies. They are, and it's important to bear this in mind, the major currencies are always against the dollar, right? It's important. Everything is against the dollar, and the biggest and the strongest economies, right, and the currencies that represent those economies. That is the case, for instance, here we have euro versus dollar, British pound versus dollar, American dollar, Swiss franc, American dollar, Japanese yen. You see, all of them are against dollar. So we have in this case 2, 4, 6, 8, 10, 12, 16. We have 8 pairs in here. These are the majors that we're going to work all the time. Okay. The important thing is that we have to identify something that I mentioned before, which is called what? It's called the base currency. Every time you see this one, the first currency is called the base, right? So this is the base currency. And the other one, this one here, is called the quote, okay? So the second pair is called the quote currency. What happens here? This is the way how Forex operates, always in pairs, right? Now let's talk a little bit about the leverage. What's leverage? Basically is the capacity that you have to control a large position, right? A large quantity of money with a smaller amount of your capital. You see, that is the pretty cool thing here, that you can handle lots of money with a reduced amount of capital. For example, if you have $1,000, let me show you here. If you have this, $1,000 in your trading account, so this is your capital, right? Your capital. And you work with a leverage of 10 to 1, right? So it means that with this leverage and you having $1,000, you are able to handle $10,000. That's the leverage. And this is a double sword, okay? Double-edged sword. Why? Because the leverage could work in your favor when you trade and you have a profitable trade, but also against you when you have a loser, right? So this is very important. This is something we're going to work later on about how leverage has to be calculated according to the amount of money that you have in your account, right? So this is basically how it works. Is the leverage. There's where the things go on. The higher the leverage, right? Of course, the more money you can manage in the market. But of course, the higher leverage, the higher the risk is. So bear that in mind. So we have to be very conscious about how we trade, right? And the position and the sizing that we're going to set in every particular trade. Now, some key concepts to analyze. The very first is peep. What is a peep? Basically, when we operate, when we place a trade, we are always trying to get the minimum amount of money from every transaction in the price. What is that? Let me show you in the charts. You can see here, for example, that The numbers are, in this case, for the price. In this case, we are observing euro American dollar. So you see this price in here and this price in here. So let's take, for example, 1.03805, right? This is the current price of this pair, the price between euro dollar and euro and American dollar. So how to interpret it? Look at this. The last number that we have in the price is a fraction of a pip. So in this case of the example is 0.2 pips. In the case of our chart is 0.5 portions of a pip. The pip starts here, right? So you have 8 pips. Here you have 0 pips, right? So you just have a portion, 0.5 pips. In the next, you are in the tens. So you see, these are fractions. These are in here units of a pip. These are tens, right? These are hundreds, okay? These are thousands, and then tens of thousands, and so forth in the price that we can see here. So it means that we pay attention to what? To these two numbers before the last digit in the price. Meaning what? For instance, when you use your crosshairs in the platform, right? You can observe, for instance, the distance between, let's say something here. What is the distance in pips from this line that I just said there and this line here, right? So how many pips are between this line and this line? So let's see. I use my crosshair and calculate in here. So basically, I have here, let's say in the 1 hour, okay, in the 1 hour time frame. So I can see that we have around almost 3 pips. I have 2 pips, 0.6. You see, it reads in there 26 points. It means 2.6 pips. Always identified like that. So if the distance is bigger, let's hit a bigger distance in the 1 hour time frame here. So what is the distance between this point here, between point A, what is the distance here between this point A and point B? What is the distance in pips? Let's see. So I use my crosshair here, and I can see that there are 64 pips, 0.3, right? So that is the distance in this moment, 64.3. You see 643 points. That doesn't mean that are 643 pips. No. Remember that we always bear in mind the 2 digits before the last one to do the calculation. Okay, so those are 64 pips. Why is this important to be understood? Because depending on the number of pips, and look at this, number of pips plus leverage is going to give you your profits or your losses, right? So that's an important aspect to take into account, okay? For this reason, we have to be very careful with leverage. Leverage has always to be according to the capital that I have in my account. If I over leverage, I can lose my capital in a very single trade. Okay, so pips are important to be understood in this aspect. What is spread now? Spread is basically, these are two types of prices that we can see in the in the charts. So the spread is the difference between the bid, sell, and ask, buy. But those are prices. So it's basically the difference between the bid and the ask price of a currency pair. It represents the broker's fee and can vary depending on market conditions and the currency being traded. For this reason, it's critical to trade measures, right? And in specific moments of the day, especially avoid them in the closing of the sessions. But that is something we're going to see later on, okay? So let me show you the spread in here. Let's hit here the 1 minute time frame. Look at this. Now the market in my time, right, is about to close. Okay. So look at these two lines. Pay attention to this. I have this green line here, right? You see this green line, okay? That is called the ask price. This is the ask price, right? So this is to buy, right? And here we have this other line that is the bid price, right? What is that? It's basically the sell price. What happens? What is the distance in pips here? Let's see. Now the spread is around 9.9. So almost 10 pips, right? Almost 10 pips. So this distance here, as you can see, from the bid price to the ask price is okay. And if I check in that 1 minute time frame, is more precise, is 10 pips, 0.2, sorry. 10 pips, 0.2. Is very wide. It's huge spread. Why? Because we enter an operation when the spread is 1 pip or 2 pips, right? But if the spread is 10 pips or 5 or 6 pips, it's pretty high, right? Because, okay, depending on the amount of money that you have, probably you can be stopped out, right? It maybe one price is going to hit your stop loss and you will lose money and you don't know why, okay? So this is very important. Always trade when the spread is small, when the spread is tight, 1 pip, 2 pips, right? Because as I mentioned before, what is that? This is basically the broker's commission, right? So that commission, what? In this case, is very wide, okay? So important thing to remember, how to deal with the spread. All right, now, what are the candlesticks? I mean, this is the most beautiful thing about the markets, to see how these candlesticks start forming, right? And what they mean. So every single candlestick represents different moments of the market, depending on what? Let's begin by that. Depending on the time frame. So here's where we start understanding our platforms. In this case, MetaTrader 5. Look at this. You can see on the left side these letters and numbers. So you see here M1, M15, H1, H4, D1, W1, and MN. Each of them represents something called time frames, right? So those are market time frames. When you see the M1 is minute, what is that? Basically means that every candle that you observe here represents a minute. So is the behavior of this candle in 1 minute. So you can see in the lower part of my trading platform, it reads 2025, the year, 02 February, the 5th, today, at 000 GMT. The behavior of this candle was huge. This was the behavior in 1 minute, okay? It moved around 4 pips. In the next minute, as you can see now, it reads like 2025 the year, 02 February, 05 to the minute 0001 Greenwich Mean Time. So it means that in the next minute, the behavior of the candle was very small, right? It moved very, very, very tight. What happens if now I go to, say, for instance, the M15, this one? It means that every candle, right, represents 15 minutes, right, of movement. So let's see. Let me go to the M15. So you see now that every candle, every single candle here is the movement in 15 minutes, right? If I go to the 1 hour, so it means that every candle is formed in 1 hour. So look at this. It was formed at 3 p.m. This one was formed at 4 p.m. This one at 5 p.m. All right, let's move to the 4 hours. So means that this very candle here, okay, this very candle took 4 hours for its formation. All of them, any of them, even this one here, it took 4 hours of trading. What happens now if I go, say, to the day candle? All right, what is that? Basically, that every single candle here, either bullish or bearish, moving what? In 1 day. It took 1 day of trading. It took 1 day of trading. How do you know that? Using your tool. Remember, you have to use the crosshair. So if I place my crosshair here, means that this candle moved on February, okay, no, sorry, on January 20th, right? This very candle here was January 20th. This one was on January 21st. This one here, January 22, and so forth, okay? So remember, depending on the time frame, every candle represents the movement in that time period, right? Now, let's understand the formations, okay, of the candlesticks. We have 2 types of candle. Well, many types indeed. But let's focus on something called the bullish, right, and the bearish candle. The bullish candle is the one that is green, okay, depending on what you consider something bullish, right, the color that you want to set, but basically is bullish. And we have the bearish candles, right, which are red, or of course the color that you assign to the bearish candle. The important thing here to observe is what it means, right? So what is the meaning? For example, why here it reads open and close, but here is on the other way, is open here and close here. Simple. Because in the moment of the session, right, this candle open here, right, and when the session finished, say the session 1 minute, 15 minutes, 30 minutes, 1 hour, 1 week, 1 month, etc. So at the moment of the close of that session, the candle closed up. So it means that this candle is bullish. But what happens in the case of this one? All right, so it probably was in a bearish market, or the movement in that time of the session for this candle was bearish. So it means that it opened high here and closed low. So the candle is bearish. Okay. How do you identify this on the charts? Very simple. Everywhere. You can see this everywhere in the charts. Let's go, for example, here to the 1 hour. Okay. For instance, if I click, say here, for instance, let's do this one. In this trading session, right, for this candle, let's analyze this candle here. This candle opened here. Okay, actually, it opened here. It was a moment it opened, right, the session. And it closed here. Okay, so it was definitely in that hour. Okay, it is around, I'd say 6. Let me see exactly the time of this candle. So this candle formed on January 20th at 3 p.m. So the session of this candle, 3 p.m., okay, was bullish. How do I know that? Because it opened low, right? Open low, and it closed high. So this is what? This is a bullish candle. Okay. It doesn't matter if the candle is forming in an uptrend or a downtrend or in a range trend. No way. So no problem. Okay. The same is going to apply. If the candle is green, it's because it opened low and closed high. All right. So now let's see the situation with this candle here, right? This one. Here it opened high. Okay, and closed low. Meaning what? That in that moment, in the session of this candle, that was around 2 a.m. on January 21st, in this moment for the operation of this candle, the trade was above, right, the level of the trend, but it didn't go up. It moved down, right? So if it moved down, it's because it closed below the price of the opening. Don't worry, that is something that we're going to check in detail in coming sessions, okay? But this is the way how we can interpret the candle formation. Later on, we will talk about the meaning of a large candle or the combinations. If there is a combination with a dodgy star and a bullish candle or a bearish candle, right? So things like that. But here, the important thing today is to understand what every single candle means depending on the time frame and the movement. If it closes, right, it opens lower and closes high, or opens high and closes low. All the time, this is going to be bearish, right? All the time, this is going to be what? This is going to be bullish, okay? So that is the thing to bear in mind regarding the candlesticks. Market hours. All right. This is the cool thing about Forex, right? You can operate 24 hours a day, okay? And from Monday through Friday. Even, for example, with the Australian session and the Japanese session too, on Sunday, you can see they're around 6 p.m. I'm talking about the time here in America. So you can find that Sunday, late afternoon, night, the market starts moving with those currencies. with yen, New Zealand dollar, Australian dollar as well. Okay, why? Because in those areas, it's already Monday. Okay, so you can operate 24 hours. Okay, or sorry, no, you cannot operate 24 hours. The market is open 24 hours, right? And look at this. The sessions are London, New York, Sydney, Tokyo, right? And there are hot spots in here, right? When two time sessions overlap. That is the case of what? The case of London and New York around this time. So the trading is pretty nice. So there's a lot of liquidity because those are two powerful markets operating at the same time, right? So these things are how we identify along the day. So from 1 a.m. to 12 around the clock. Okay. So this is the way how we interpret, and this is how we know that the market operates 24 hours. All right, now let's talk about the type of traders. It's critical for us to really understand what kind of trader I am or I want to be. But that depends on what? Depends on my psychology, right? On my psychology, my risk appetite, okay, my capital, and of course, my time. We have a first type of trader. This is the trader that trades in the day, called the day trader. Basically, this trader, and look at this, buy and sell currencies on the same day. So the operations can last from minutes to hours, but closes the operation the same day. So, for instance, if I trade Monday at 9 a.m., so I'm going to close my operation no matter what at 3 p.m. or before if the operation hit my target profit or my stop loss, whatever, but the operation is open and closed the same day. That is the first type. The second type of trader is the swing trader. Okay, look at this. Holds positions for a few hours to weeks. All right. So this trader can keep the position open, for example, 1 month. But the more you trade like this, okay, the more you have to be aware of your capital, right? Sometimes some traders operate low amounts of money with the proper leverage. And of course, they can keep their operations open for weeks without the risk of losing a lot of money. Why? Because they have their stop losses and everything considered according to what? According to the type of trader they are. Now we have position traders, okay? So these ones are those who hold their positions for long term, okay? Months, years, okay? That's another type of trader. And finally, we have scalpers. The scalper is focused on spotting operations that last seconds or minutes, okay? Basically, they operate the very low time frames, the 1 minute time frame, the 5 minute time frame, the 15-minute time frame. Why? Because they know that the life expectancy of the trade is minutes, okay? And sometimes, most of the time, these scalpers also trade in news. That is something that later on we are going to learn how to scalp, how to trade the news, okay? So this is it. This is how we are going to determine what kind of trader I am, right? Of course, if my risk appetite is high, is moderate, is low, right? The type and the amount of capital that I have. If it is moderate, if it is low capital, right? If it is high capital, those are things that we have to consider before trading. Okay. Now let's see about some tools that we can identify in our platform. I suppose that you are working with MetaTrader 5. This is the platform I am currently using. And there is something that you can start working on, and is getting to know the different tools that you have. Let me show you what a clean chart is. For example, this is a clean chart. This is the typical chart that I use when I am trading news, when I am scalping the news. But there is another type of chart that I am pretty sure is the one, including myself many years ago, used to work on. It's something that I call confusing charts. It's this. Please avoid at all costs setting up your MetaTrader platform or any platform like this. No, no, no. Why? Because you are filled with lots of indicators. I don't know, OBV, DMI, ADX, momentum, MACD, ADX, ATR. Here you have parabolic, Ishimoku. You have a lot of EMAs in here. So it's very confusing that you barely see the candles, right? No. So we have to keep a clean desk, only using what we need. Okay, and that is the thing. And this is just to close this first session about how we set up, and that is the next session for this first module, and is how we set up our charts in order to be clear. Okay, some traders, very advanced traders, they only use something like this. They only use the basic thing, right? So they use all of this because they trade based on prices and things like that, okay? Or something clean like this, okay? With pivot points and the most remarkable or meaningful EMA formations, okay? And things that you can really find helpful. But if you keep your charts very full of indicators, objects, and lots of things, the trading is not clear, right? So that is my final advice. My final conclusion here is keep your charts clean, easy, simple to understand. Okay, so my dear traders, once again, if you found this second, right? Basically, this is the second video. If you found this useful, meaningful, and somehow clarified doubts that you had about the Forex market, please feel free to contact me, okay? Give me your comments in English, Spanish, Portuguese. Subscribe, please. As I mentioned before, I'm trying to build a community of traders with clear information, with down-to-earth concepts and trading strategies. But first of all, we need to know the market, okay? So please subscribe, share the contents. Activate the notifications. And thank you very much. See you in our next video. Thanks a lot.